Hi, good morning, and thank you for joining today's webinar. Before we get started, I want us to take note of a few housekeeping rules. We would like to mention that this video is being recorded and will be posted on our YouTube page. Currently, all participants have been muted. During the Q&A session, you can raise your hands and be unmuted to speak. You can as well drop your comments in the Q&A chat box on your screen. To make this session more interactive, we have created polls for your feedback on the issues in the industry. Now, I would hand over to Erica to start the webinar. Thank you.
Thank you very much, Dorcas. You're all welcome to today's webinar on the upcoming regulatory changes, and we will start shortly. Before we start, I would like to introduce the hosts and the panelists for today's webinar. So we have Dr. Situ. We have myself, who will be our moderator for today. And then we have Dr. Situ, Dr. Kwabena Situ, who is an assurance partner and also doubles as the Deputy FSI lead here in Ghana. We also have Charlotte. You're welcome once again.
Thank you very much, Erica. Dorcas, good morning to our distinguished ladies and gentlemen. It's a pleasure to welcome you to today's webinar, where we'll be discussing the upcoming regulatory changes from the Bank of Ghana. As many of you are aware, Bank of Ghana continues to play a pivotal role in shaping the regulatory landscape of our financial sector. The newly released draft directives and guidelines, they are significant steps towards strengthening. The newly released draft directives and guidelines are a significant step towards strengthening governance, enhancing transparency, and promoting stability within the banking industry. These guidelines and directives, they address key areas such as the ICAP, stress testing, management and measurement of interest rate risk, recovery planning, liquidity management, and liquidity monitoring tools. Today's session aims to provide clarity on the main provisions of the draft directives, explore their potential impact on financial institutions, and also highlight implementation timeline expectations from the Bank of Ghana, and offer a platform for key stakeholders to share insights and raise pertinent questions. I encourage everyone to engage openly, as your feedback and perspectives will enrich our discussions and also contribute to the ongoing consultation process with the Bank of Ghana. Many thanks to the panelists who have willingly accepted to be with us this morning, and I trust that we'll have an interesting conversation. Thank you very much. And Erica, I hand over back to you. Thank you. Enjoy the webinar.
Thank you, Mama Shao. Thank you, Charlotte. So we move on to Dr. Kwabena Situ. Dr. Situ.
Yes, Erica, good morning, everyone. Yes, good morning, everyone, and nice engaging with you today. I think I'm so excited today because virtually we have all the banks joining us for this very important webinar. You know, you can't take away the fact that we are in a dynamic, business environment, and the environment continues to change, and I like what Charlotte said, that whatever the Bank of Ghana is doing is aimed or is targeted towards strengthening the banking industry. So you look at what the Bank of Ghana has done over these past few months is to issue out 3 directives, and I know there is more coming, 3 directives, and then you have also 3 guidelines that the Bank of Ghana has issued. And in today's webinar, we are going to deep dive into some of these directives and guidelines and what are the main key takeaways that banks need to be thinking about. So, for example, you look at the first directive, which deals with the liquidity risk management, and you look at the objective, like the objective for the liquidity risk management is to maintain high quality liquidity buffer, all right, for the banks. And we are going to dive into what are some of the key requirements within the liquidity risk management directive. Also, the Bank of Ghana has issued the liquidity monitoring tool. And this is an interesting one because it actually, in fact, I like this tool because it practically helps the bank to monitor their liquidity positions. And we are going to highlight some of the key things within that tool. Also, one of the directives that has been issued by the Bank of Ghana is the Recovery Planning Directive. And all that the Recovery Planning Directive seeks to do is to help banks to develop a very robust recovery plans. And we know that recoveries are one of the main headaches of the banks in Ghana. So this directive will actually help banks to actually develop a more robust, recovery plan when it comes to such recovery. So a lot to deal with, a lot to chew this morning. So we will ask that you pay particular attention. But if you also look at the guidelines, the 3 guidelines that has also been issued by the Bank of Ghana, you realize that the first guideline, which deals with the ICAP, basically what it seeks to do is to help in addressing the bank's capital needs. All right. And I think this is a very good guideline. The other guideline, which also is of much interest to me, is the stress testing. Is the stress testing. And with banks, they are faced with a lot of scenarios. With this stress testing guideline, it will help maintain a very robust and forward-looking stress testing scenarios that the bank needs to go through so that when things happen, the banks will not be taken by surprise. So this stress testing guideline is also a very good one that the Bank of Ghana has issued to guide the banks in carrying out some of these things. And then not all, but we will also be dealing with also a very important one, which is the management and measurement of the interest rate risks. Now, with that guideline, we know that it will help manage, measure. Not only that, it will also help to monitor and control and also report on interest rate risks. So it means that the Bank of Ghana has issued all these directives and guidelines so that the banking sector will be very strong. And I think this is a very good thing. It's a very good thing that the Bank of Ghana has done, and in the coming months, in the coming days, you are going to see Deloitte, going deep dive into some of these things for the banks. In fact, we are coming up with series of articles. In addition to this webinar, we'll be issuing out series of articles to deep dive some of the key areas that we think banks need to focus on. Just to conclude, our other panelists come in, is that the role of the board cannot be overemphasized. In fact, the governance structure around all these directives and these guidelines, the importance of the governance structure around these directives cannot be overemphasized, because you have the role of the board, you have the role of senior management, and then you have the role of the internal audit. So all these things play a very important role in ensuring that these directives and these guidelines are properly implemented, and then the benefits are fully reaped. So, Erica, I will end here for now. And as the discussion progresses, I will come in as and when, I need to come in to chip in one or two things to bring clarity to the whole discussion. So and also keep your questions coming, because we want to make sure that this section is very interactive. Your questions are being responded to. So keep your questions coming, very important, so that we can address them as we move along. So thank you very much, Erica. And I will sign out for now, and I will definitely come back to highlight some of the key requirements in these directives and guidelines. Thanks.
Thanks so much, Dr. Situ. That's a very interesting one, and I'm already excited to hear more from the panelists. So we'll start with Mauko. Mauko, you are welcome once again. So we want to know what are these new directives and how is it going to impact banking operations going forward?
Thank you, Erica. Good morning to everyone. I'm really grateful for this opportunity. Kudos to Deloitte for providing this platform to better provide some appreciation as to the regulations that the Bank of Ghana continue to issue. And of course, this is an opportunity to facilitate implement these regulations. Before I go into your question, I wanted to take a step back, right, to get some perspective as to where we were before coming to this point. So back in 2017 to 2019, where we painfully had to go through this banking cleanup exercise, we realized that in order for the industry to avoid such a situation again, we needed to go through what we call a regulatory reform agenda. So that was developed. There was a roadmap that was developed that's about a 10-year plan to ensure that we build resilience across the financial system. So in doing that, one of the key things that we needed to do was enhance the framework, our capital framework, and we aligned it with the Basel Capital Framework, which, of course, the Basel Committee remains one of the main standard-setting bodies for all banking supervision and regulations. So that was what we did. And if you quite remember, we issued a Capital Requirements Directive back in 2018 to help in that process. So that was basically the first stage in regards to the Basel Capital Framework. Now, the framework, we can classify it in three pillars. The first pillar is what most people know as the capital adequacy ratio. Now, that focuses on just three risks, okay? Credit risk, market risk, and operational risk. Then we have the pillar 2, which focuses on the institutions. The institutions, and here I mean the banks and the specialized deposit-taking institutions, being able to develop their own understanding of risk that they are exposed to, because they know their business activities, and so they should know what risk they are exposed to, and how well are they able to manage these risks, and then provide adequate capital for any risk that they need to mitigate. So that, in general sense, is the pillar 2. And within the pillar 3, we expect that these institutions would provide some disclosure, okay, on what they have done and their performance. So largely, that is the three main pillars. And currently, what we have tried to do is to focus on the pillar 2 aspects. So within the pillar 2 aspects, we've already issued what we call the credit concentration risk guidelines, and that was done last year. This year, we intend developing other directives and guidelines. But for now, we have issued 6 directives and guidelines. Now, these 6 directives and guidelines include, as Dr. Situ rightly mentioned, a guideline on stress testing, guideline on the internal capital adequacy assessment process, which is generally termed as the ICAP. We also have the guideline on the management and measurement of interest rate risk in the banking book. It's important that we include in the banking book, because when it comes to interest rate risk, we have that in the banking book and that in the trading book. Now, the trading book had been covered under the market risk within the capital adequacy ratio computation, as we all know as CAR. Now, we also have the Liquidity Risk Management Directive and Liquidity Risk Monitoring Tools Directive. And these are very important for the industry because for ages now, we've not really had regulations around liquidity. The regulations have been minimum. And so this is very important to us. Like individuals generally say, across the globe, liquidity is an instant killer. Once you have liquidity issues, the bank generally would be dying, would be failing. Solvency, which includes capital, is a slow killer. It takes time, like slow poison. So it's very important that liquidity is considered carefully by our industry. Now, there is the last directive, which is the Recovery Planning Directive. That directive is very unique. It has to cover, it considers our resolution regime. So it's more or less looking at how the banks are able to recover from any shocks to the institution. How viable are they when their critical functions go down? How quickly can they recover from these issues or disruptions? So largely, these are the 6 directives and guidelines that have been issued. And mainly, the expectation is that these directives and guidelines would strengthen our industry's risk management practices and, of course, transition our institutions towards a more rigorous, forward-looking approach to risk management, all aimed at what? Enhancing resilience and ensuring financial stability. So on this note, Erica, I would like to take a pause.
Thank you so much, Mauko. I think these are very interesting insights that you've shared with us, and you've actually given us a background on what Bank of Ghana has been doing over the years. And I think you've also given us a sense of more directives that are coming up. And I think before the webinar ends, we will also ask you maybe to give us a hint on some of the directives that we should expect. Thank you very much. So we'd like to call on Kwame. Kwame, we've heard from Mauko, who has given us the regulatory perspective of how it's going to impact banking operations. Can you tell us, from your perspective as a leading consultant in the financial services space, what should banks expect given the issuance of these new directives and guidelines? Hello, Kwame, if you are speaking, you're on mute.
Thank you, and good morning to everyone on this call. Yes, like Kwabena and Mauko has already highlighted, these directives and guidelines are basically to ensure resilience. I call it resilience in the midst of uncertainties. You see, our banking sector, our financial services sector is on a path, and we have reached a level where we need to complete the gains that we have, because in the past we have had some experiences which we would not want to have again. So as a regulator in the bank, and then we need to ensure that these gains that we've had so far are consolidated. And like Marco rightly put it, he says we are looking at all the directives that ensure that we have a robust banking sector. So let's go through the guidelines one by one. Maybe we'll start with the directive one by one, then we'll get the guidelines. We start with liquidity risk management. it talks about basically how we manage liquidity risk in the bank or in the financial institution as a whole. So it's not going to be business as usual as we have always been doing, where in the past we would just wait for things to happen to us, we just respond, but rather directing us to be proactive. So we should make sure that the board and senior managers are involved when it comes to liquidity risk management. There's a framework in place, and this framework is not just anything but something in place that will guide everybody when it comes to how liquidity is to be managed within the entity. So we should be looking at liquidity stress testing as well, whereby we look at scenarios where we can, assume unfavorable conditions and then see how we will fare. Like Malcolm mentioned, he said liquidity issues is an instant killer. So you don't have any room for error when it comes to liquidity. So you need to be prepared for all circumstances and make sure that your bank is resilient enough so that when these shocks come in, you will have a plan B and you'll be able to recover. You will not die, as Malcolm mentioned. So the liquidity risk management directive is supposed to help us to position ourselves well against that killer, that instant killer of liquidity, which can spoil all our activities or derail the efforts that we've put in over the years. Then we look at the next directive, which is liquidity monitoring tools, whereby the Bank of Ghana is asking all banks to report on the 6 cardinal areas when it comes to monitoring liquidity. We are looking at the BOG prudential liquidity ratios. We are looking at the contractual maturity mismatch ratios. We are looking at the concentration of funding. We are looking at available unencumbered assets. And we are also looking at liquidity coverage ratio by significant currencies. We also have to report on market-related monitoring tools so that we would be able to position ourselves well. We will not just be surprised by any liquidity shock, but we will be informed and as a result, position ourselves well so that we would be able to take the right strategies and then make sure we don't get to the stage where liquidity becomes our instant killer in our case. So for all banks, I think this is one of the novel directives that we should embrace with all arms. Especially, Bank of Ghana has taken the pain to go ahead and develop templates for each of the 6 key liquidity tools that you need to report on. This report is going to be monthly. I think it's going to be the 9th of the next month after the month has ended. So all banks should take note and make sure that you are familiar with the templates that the central bank has provided for us. So I think when it comes to the other directive, looking at the recovery planning directive, it is also talking about how banks are resilient when the unexpected happens. And this time around, it's not looking at only liquidity, it's looking at credit risk, it's looking at market risk, it's looking at operational risk, it's looking at IT, it's looking at market risk, it's looking at every other risk that you can think of. So it's like in the event of a failure in one system, are we going to go down with the system or we have some shocks, some buffers to absorb the shock? So we should, so that's why it's very key that it shouldn't be only some few people who are engaged when it comes to ensuring that these directives are complied with, but rather it should encompass all the people in the value chain, from senior management to IT to audit to external auditors to consultants to treasury, finance. Everybody should be involved. It's HR. Everybody should be involved. It shouldn't be something, because once something happens, it's not going to affect only one aspect of the business. It can affect any other aspect of the business, and especially with the evolving changes and the uncertainties in our industry of late. If you look back between 2022 and 2026, there are significant uncertainties that has happened. Look at how at a point treasury bills were in the 28% and all those things, and now we are hovering around single digits, where at a point FS risk was a significant risk where people were trying to shield themselves through investing in foreign currencies, but now the story has changed. So I think it is something that all stakeholders in the value chain should be involved so that the banking sector will be resilient. It talks about stress testing as well. The stress testing guideline talks about how we should stress out all our possible scenarios so that we would not be surprised by any event that can destroy us or that can affect the continuity of our business. So these directives and guidelines are not just to come and then add up to the many directives that are redundant, but to be embraced so that we can all together salvage our banking industry and grow to the next level. What I see in the Ghanaian banking sector is that we are transitioning from one era to a new era. One era being the era where banking happened to us, to an era where we are going to determine how banking is supposed to be done in our country and our region as a whole. So it shouldn't just be business as usual where banks should just employ anybody. Banks should just use any strategy. We just wake up, then things happen, we read the news, and then we move on. It should be something that we are deliberate and intentional. And I think some of these directives on ICAP, previously, IRBB banks will not be bothered about it because they will say that, oh, this is a foreign concept. But look, between prior and last year and this year, the GR Ghana reference rate has dropped significantly. And look at how it's going to affect the profitability of banks. Because if you don't put in the right strategies and interest rates just fall or increase at any moment, material moment, it's going to affect you significantly. It's going to affect your liquidity planning. How is your liquidity matched against your liabilities? How are you ready when certain liabilities fall due? All these things are being intentionally directed by directives so that we will not just sit down for a bank for events to happen to us, but we will rather be a step ahead of everything that is likely to happen to us, and we'll be able to position ourselves and have a resilient bank despite the uncertainties that we are facing in this phase of our banking industry.
Thank you so much, Kwame. That was very loaded. And I believe that it just goes to show that there's a lot more to come. Thank you very much. So now I would like us to move to Maoko. Maoko, can you tell us the anticipated timeline and finalization of these directives?
Yes, thank you, Erica. So rightly within the directives, if you look at the second page, just after the cover sheet, we tend to indicate for how long we would expect the exposure draft to remain on the website. So in this case, we give up to the end of June. Now, this is the first time, it's actually unusual, this is the first time we've gone this long in terms of the number of months. And that's because of how unique these directives and guidelines are. So the directives and guidelines, especially when it comes to the management and measurement of interest rate risk in the banking book, it's a bit technical as compared to some of the other directives and guidelines we've issued in recent past. So we felt that we needed to have broader engagements with the industry and ensure that they have adequate time to actually go through these directives and guidelines and give us their comments. In terms of the implementation, we currently would be looking at the end of December 2026. So effectively, we expect banks to commence implementing these directives and guidelines on the 1st of January 2027. That is the plan moving forward. But of course, we are open to suggestions from the public, from the industry with regards to the implementation deadline. If we need to go back to the drawing board and consider the issues raised by the industry concerning the implementation deadline, we'll do that. And then we'll probably would look at amending it if need be. Thank you.
Thank you very much. So before you go, there's actually a question, but you are the regulator, so I want you to be able to answer that. Someone is asking if that is Nuhu Fahad. He's asking where he can get the guidelines to study it. I know it's a public document, so maybe you can tell him where he can find it. Would it be on the BOG website? Just to
Absolutely, Erica. So we always publish our directives on the Bank of Ghana website. You need to go to our website. There's a section on supervision and regulations. Within that section, we have the directives. So you can click on the directives and you have a tour list of directives and guidelines that the Bank of Ghana has issued. Thank you.
Thank you so much, Malco. Yes, Kwame, thank you for your earlier insights. We would like to also know how can banks position themselves to actually benefit from these new directives? Is it just that we following the directives, making sure our frameworks are on point? How can banks actually benefit?
Yeah, so I think thank you once again, Erica. And I think when it comes to these directives, I would say these are not new things to us as bankers, if I may say. It might be new to some few people or to some people who are new to the banking industry. But if you are a banker, then these directives shouldn't be something that you are new to. Just that this time around, it is being spearheaded by the central bank. So it means it has gained regulatory importance, and as a matter of fact, we have to pay attention to it. So as a bank, you would need to go back and then look into your policies and your framework regarding these areas, regarding liquidity, regarding your ICAP, regarding your stress testing, regarding your IRBB. If you have not done it, then you have the opportunity to build capacity. You also have to ensure that you engage fully. You don't just sit in one side in your silo and then try to make sure you are complying. Because if you look at the nature of the directives, especially things like the stress testing, you are not just doing it within the risk function. You are doing it across the entire banking sector, and as all your departments and all your units. So you try to fully engage, bring everybody on board so that you will get their buy-in, you will get their support when it is time for you to, roll it out and then implement it and be compliant with the directives as BOG has iterated. Like Malcolm mentioned, in 2027, most of these directives are likely to be operational. And so this is an opportunity for you to engage all key stakeholders so that they will be able to prepare adequately. You also need to strengthen your stress testing and contingency planning capabilities, because now what is happening is all these things are going to ensure that you don't just go to the banking hall and then do banking as usual. You should be assuming all possible scenarios that can affect the operations of the banking sector or your operations, so that you will be able to position yourself, even when it comes to redefining your risk appetite, redefining your approach to your risks that you accept. You have to have a look at it again. Like I mentioned earlier on, you have to look at your policies and your frameworks once again. And then also, the good thing about this is the enhanced disclosure and regulatory reporting requirements that these directives are bringing. It's helping everyone to be on top of their business. So I would like to end by saying that this is an opportunity for banks to build capacity in these areas. It tells us these areas are the areas that the regulator is interested in, and not just for the regulator, but for you to be able to be resilient in this uncertain time. So I think banks, you have a lot of work to do, and there is a lot that you can do between now and the end of the year where these directives are fully operational. So let us not sit down and wait till the last hour, but rather prepare and then be in position to comply. Yeah.
That's a good one. Thanks so much, Kwame. I think Dr. Situ,
Yes. So just wanted to add to what Kwame just said, and I think it's also very important that we realize that this shouldn't just be a tick box fulfilling all righteousness, but we should take it seriously. Apart from reviewing and updating the policies and things like that, I think we should also realize the fact that the board plays a very important role. And I think I mentioned it earlier on. So we should ensure that the board and senior management of the bank are fully engaged and trained. And I emphasize, the board and senior management of the bank are fully engaged and trained. And I think this is very important because ultimately the decision lies with the board. So if the decision lies with the board ultimately, and the board doesn't understand these things very well, they've not been fully engaged on the details of these directives, then there is a problem. So that is one practical step I think we should really look at. Also, when these things have been issued and the bank start implementing them, we need to be thinking about reporting capabilities. How do we automate some of these things so that, because it has come to stay, so the reporting capabilities and things like that must be automated in such a way that it becomes part and parcel of the reporting requirements of the bank. So just wanted to add to what Kwame said. Yeah, thank you.
Thank you so much, Dr. Situ. That's a very good one. Now we've heard from Mauko from the regulatory side. We've also heard from Kwame and Dr. Situ from the consulting side. I would like us to hear from Charlotte from the audit side. We want to know, how are these new directives, Mama Shao, how are they going to impact how banks are audited going forward? I know we as Deloitte, we are auditing about 6 banks right now. And even today and the coming weeks, we'll be working to sign some of the reports. So just give us a perspective on how is it going to change the way you audit going forward?
Thank you very much, Erica. And yeah, thanks to Mauko, Kabina, and Kwame. So Erica, well, as auditors, I know that most of the time we go to the clients, and after the monies have been spent, then we are now going to find out whether it's spent right or not. Basically, that's what audit is about, we say. But actually, the profession has moved on from that, as we are all aware. Because now, when we are auditing, we don't just look at the numbers, we have to go behind the numbers to find the story behind those numbers, and then what led to us even having the report, the kind of reports that we have. So in a similar manner, when it comes to these directives, we cannot sit on the fence, or we cannot just expect that the banks have done this, so we are just going to review. Auditors, as auditors, we are expected to also know the directives ourselves. We need to also know the directives, read about them, even span out or even pinpoint the kinds of policy changes and updates that the Bank of Ghana is expecting the banks to run. And then when we go in there, we are going to now review and ensure that banks have complied with the various requirements in the directives. So as mentioned earlier, there'll be policy changes, there'll be some updates. I think that we'll see internal audits playing a lot more roles in this matter, as we also ensure that our boards and their respective committees are playing their roles very well. So auditors, we are supposed to know these directives and then come up with our programs. We use our programs for the audit, so we need to update. We are not just going to use the old programs that we have been using, even for, let's say, 2025 audits. There will be changes once these directives come into operation. So we need to ensure that we know them and we know what to expect. We pin out what to expect, and then when we go, we will look at them, we review them. where they have to be returns, for example, filed in the Bank of Ghana at certain date in the month or in the year or in every quarter, like we have been doing now with the returns. We will check for that as well. Where the policy changes, it means that we ensure things have done, and then we'll also update in our own files, because the main thing we do when we go is to understand the company or the bank. I think the best key documentation that we do in our files. So we will also update our own documentation. So if you have to do that, then you see you have to understand what they're saying. So this session is also important for us. We need to understand. We need to find out what are the changes that are coming, and we need to ensure that the banks are complying with them, so that if there's any deviation at any point in time, then we can pick them up in our management letter points, in an insight that will provide after the audit, so that the banks can operate better. I mean, when the banks are operating better and growing, that is when, you know, for us auditors and consultants, we also have a lot more businesses and revenue. So yes, business as usual for us is also not it. We need to know, we need to understand, and then find and ensure that the banks are complying with them. And I hope this helps, Erica.
Yes. Thank you so much, Mama Shao. So Mama Shao is basically saying that as auditors preparing for coming in the coming audit, so it's so also prepare to make sure that everything has been put in place, because she's going to really look into it and compliance. There's compliance. I think Dr. Situ wants to speak. Dr. Situ, you can go ahead.
Wanted to add to what Charlotte just said. I think, Charlotte, you cannot throw more what I'm about to say. I think these directives also very concern assessment of the banks. The going concern assessments. So, like the liquidity, directives and the stress testing and all that, is going to serve as input for us to ask the going concern of the banks. So if maybe the bank thinks that it's not going to have a bearing on the audit, I think concern assessment is going to be serious and a major, input into that. Maybe Mama Shah could throw some light on that.
That's very right. So you see, I mentioned that we are not going to do things as business as usual. We have been doing the concern assessments, for example. But you see, now it means that other perspectives are going to come on board based on the directives. So if in the past, or even as of now, we just look at, let's say, budgets that they have in the subsequent years and what the board and management have put in place, the plan they put in place to ensure that the banks continue to operate in the next 12 months. This time, we are also going to be more robust in looking at the liquidity, in looking at what the directives are saying, so that as part of the going concern, management has to do that assessment first. Then when we go in, we also go and review and ensure that the assessment is right and tells the right story. If after the audit we don't say anything about how these directives are impacting our going concern and all that, and then God forbid, but the bank collapse, you see that that's the reason why everybody will ask, where were the auditors? Where were the auditors? So that's one of the major areas that will be impacted, and we are going to review to ensure that the banks have what is required in place, and then the assessments are done, meeting using the right parameters, and then leading to the right ratios and all that. So yes, Commissioner.
Yeah, exactly. And since the effective date is 2026, and then from February 2027, it needs to be that. I think the auditors will also be checking what the bank has done so far in respect of some of these things. If the bank has not started any work at all when the audit for 2026 is happening, then it's a big... Exactly. So I think the bank needs to really start work on this thing now, put in place your team, and I'll always encourage that, look, you need to also consult widely. And I think you could leverage on some of the experience that consultants like Deloitte have, and then you can also leverage on that experience and exposure that we can also bring to bear. So Erica, I think just wanted to make that point. Yeah.
Thank you so much, Dr. Situ, and thank you, Mama Shao. We affectionately call her that in the office. She's like a mother to us also. If you hear me say Charlotte or Mama Shao, I'm referring to the same person. Yes. Okay, thank you so much. So I would like us to go to Mauko. Mauko, I want to find out if there's any additional supervisory guideline or any workshop to help banks interpret and implement these new directives.
Yes, thank you, Erica. So that is something we do in practice. Whenever we issue directives, we tend to have engagements with the industry, especially. So this will not be any different. What we intend doing is that we would meet with the various key stakeholders. For example, we tend to have engagements with ICA Ghana. We also have engagements with, for example, the Ghana Association of Banks, GAB, and we also have engagements with the chief risk officers, the compliance officers of the banks and specialized deposit-taking institutions. So this is going to continue. We would probably enhance these engagements further, and similar to what we have going on right now, we will do the same. There will be webinars, and at the same time, there will be in-person engagements. Participants should stay tuned. They would hear from us with regards to the various engagements or plans that we have moving forward. Thank you.
Thank you, Mauko. As we rightly heard from him, let's stay tuned for the upcoming plans and workshops that BOG has for us. Thank you so much. I see Peter is also on the call here with us. And Peter, you are welcome. I'm sure there are lots of questions in there from the participants, so we will get right into it, and then we will also hear your insights on some of these directives. You're welcome, Peter. Okay, so I want us to let's move to the next.
On call, and then I'll be available for any follow-up. Okay.
Yes. Perfect. Thank you very much. Kwame, I want to find out, does Deloitte have any upcoming capacity building areas that banks should watch out for? Any capacity building areas to adequately prepare for the implementation of this new directives?
Yeah, thank you, Erica. And then we are rightly here on this webinar. We are being proactive rather than being reactive, because these directives are not yet issued, but we want to engage so that we would let all parties who will be affected become aware. So this is the beginning of a lot of webinars on these directives. We are going to have a lot of thought leadership on these directives. So watch out our social media platforms and then all our spaces. We will also be having a financial risk unit conferences with various banks. So we'll have a conference with your financial risk unit. So when we come and then we want to engage, we want you to open your arms so that we can engage and then help you to be able to align. We will also be sharing tidbits on these new directives on our social media platforms as well. Then we will also help stakeholders by assisting them with the gap assessment, because as we speak now, we are now going through the directive phase, but we need to assess the gaps that banks have in terms of complying with these directives. And with that, we can be of help and we can assist you to do your gap assessment so that you will know the gap that you need to close, so that the deadline of 1st January 2027, you would be in compliance. So Deloitte is not leaving you just like that. We are not just sitting there and then watching you go through the struggle. We are ready to work with you. We are ready to hold your hand. So when we knock on your doors and we come in there, don't think that we are just there to make our presence felt, but we want your business to survive and thrive in this what do you call it, in this uncertain times. So we want to partner with all banks. We want to partner with every financial institution so that we will be compliant and then we will be able to build resilient banks. So our doors are open. My Kwabne's hand is up. I know he's also going to speak more onto it. We're going to have a lot of thought leadership, more webinars, and then tidbits. We are going to actually pick each of the directives and then have a session on them, maybe in due course. So be on the lookout, and then we are not going to leave you hanging in the middle. We will be with you throughout this journey. Pabna, maybe you can say
Yes, yes, thanks. So I think Kwame left out a very important one. The biggest of them all is the banking bootcamp. So last year we had the first ever banking bootcamp. And this year, because of this directive, we are going to refocus our attention on the banking bootcamp, on some of these directives, and then deep dive into some of them. So in September, this September, we are going to have the second banking bootcamp right here in Ghana. So the notices will go out very soon. Please, when you get the notice, lock your calendar. It's going to be a 3-day intensive banking bootcamp. I think it's either July, we will confirm and communicate. But when you get the date, lock it down, because in that 3 days intensive bootcamp, by the time you are leaving, you will be able to deal with all the requirements that Bank of Ghana has issued through the directives, and then I think you'll be good to go. So watch out for the banking bootcamp this year. It is coming on live, and it will be the second edition. Thanks, Erica.
Thank you, Dr. Situ. I'm so excited already. And I'm looking forward to the boot camp. Last year was super amazing, and I know some of you here were at last year's boot camp, so you know how it's going to be. Thank you so much, Dr. Situ. I forgot to mention that Peter is also from Bank of Ghana, and he's actually the divisional head of the Banking Supervision Division. So Peter, you are welcome once again. Mauko, so my last question for you, before we get right into the question and answers, is that my last but not the least, are there any other regulatory areas? I think you gave us a hint from your earlier submission that there are more coming up. Maybe we want you to tell us which areas of emerging risks, which areas should we look out for?
Yes, thank you, Erica. So, I mean, the panelists have all said, we live in a world, or the banking industry it continues to evolve, right? There have been constant innovations and rollout of various products to attract customers and other consumers. So, obviously, the kind of risks that they'll be exposed to would also be different or be new, hence what we call emerging risks. We also have to consider the fact that there are other regulations or regulatory gaps within the industry that we need to look at and try to bridge such regulatory gaps. And so based on all of these things, and like I mentioned from the beginning, we have a plan, a 10-year plan for rolling out all these regulations. Key regulations we intend issuing would be one, the credit risk directive. If you remember, last year we issued what we call the NPL reduction measures notice. That was an NPL notice that we really needed at that time because of how high our NPL ratios are within the region. If you go out there to other countries within the sub-region, you realize that Ghana actually has one of the highest non-performing loans ratios, that's the NPLs. So we needed to come out with a reduction strategy for that, to more or less reinforce what we did last year. We will be issuing the credit risk directive. We'll also be looking at operational resilience, especially since the COVID, when we've had to rely on the digitalization. You realize that if our institutions don't have what it takes to ensure that where there are disruptions similar to what we experienced, then there may be a situation where they will be unable to continue with their transactions, with other activities, and that would also affect our customers and consumers. So we have plans to issue operational risk and operational risk resilience directive. We also have one key area that we need to look at, and this stems from the lessons we learned from the cleanup back in 2017 to 2019, and that has to do with related party transactions. So we intend issuing a directive on related party transactions to curb the risks emanating from transactions regarding related parties. So these are a few of the directives that we intend issuing very soon, hopefully by the end of this year. Thank you.
Thank you. Thank you so much, Mauko. Wow. As Mauko rightly said, there is so much in store for us that is coming from Bank of Ghana. So let's look out for more. Thank you so much, our dear panelists. We'll get right into the question and answers. So I think if now your participants, your mic is, you can now unmute your mic. I think I'll take 3 questions. If you want to speak, you can raise up your hand and then we can call you. I can take 3 questions and then I will read the questions in the Q&A chat box as well. If you've already asked your question in the Q&A chat box, but you want to speak, you're also free to do so. You're also free to do so. So we can keep the question coming. Whilst we wait, I've not seen any hands up, so I'll go right into the chat box. There's a question from Daniel Ahiale Jani. Daniel is saying that value creation of every business enterprise involves everyone. The discussion passing to suggest negligence or lack of commitment from some people within the value chain. What specifically has Bank of Ghana found missing to emphasize their involvement in these directives? To emphasize their involvement in these directives. I don't know if Mauko, you or Peter wants to speak on this. This question is directed right to Bank of Ghana.
Okay, thank you, Erica. So more or less, when we are issuing these directives, we have a plan. I think I've elaborated on the fact that we came out with a 10-year plan, a regulatory reform agenda. Now, in issuing these directives, what is key to us is who are the audience. Once you know who the audience are, do you think that the audience are able to grasp and understand what exactly you would want to issue as your directive? Because if they don't understand, then implementation becomes a problem. So that is why it's very key to us that when we issue these directives, we have the consultation phase. Okay, so we engage the industry, we engage the auditors, we engage the board, the CEOs, the chief risk officers, because we need all of these bodies on board in order to ensure effective implementation of these directives. And that's critical for us because these directives are at the enterprise-wide level. That is how we see it. And at the same time, for each individual within the bank, for each business line within the bank, we expect that they appreciate what kind of risks that they are exposed to and how best can they mitigate or manage these risks. So this is why it's very key to us that across the value chain, all through, from the lowest level to the board, everyone knows the role that they play and understand what exactly our expectations are. So for Bank of Ghana, that is where we are coming from. So it's not just about negligence, no, it's about ensuring that the entire industry are aligned with what we intend doing, what our objective is, which is to promote the safety and soundness of the banks, the SDIs, and of course, the banking system. Thank you.
Thank you very much.
And Erica, just to add a little spice to what Marcus said, and he's very right. So everybody in the value chain is key. So that's why we issued this and put it on our website, which is not restricted to just banks or players in the industry, but everybody. So the expectation of the central bank is that everybody, a customer, a client, whoever is, go up there, take a read of it, and as and when you have input, you can make your inputs. If you want some clarifications, you know, we've put in there where to seek that clarification. So we just want to make sure everybody within the value chain is covered, because everybody is key when it comes to safety and soundness of the banking system. Thank you.
Thank you, Peter. Thank you very much. That's a good one. I think there's a question also from Nathan. Nathan wants to find out their plans for or similar guidelines for the rural banks. Are they also part of the target? I think either Peter or Mauko can take this.
So currently, we are having a microfinance reform. So if you even go on our website, you would get to know that the Bank of Ghana, in consultation with the Ministry of Finance, is having a reform within the microfinance space. Now, when all these things are completed, these directives that we have issued would cover them in certain proportionality. So you are not going to have the totality of everything that we have issued to cover every financial institution. There's going to be proportionalities involved in all of these things. Now, once we are done with the reform, we're going to take them through the same measure that we are doing with the banks in terms of exposure, in terms of training, in terms of consultations. We are going to be available. So trust you me, they'll be covered in the proportions that relate to them in terms of they doing the business of banking in the very near future.
I think, thank you very much. It's very interesting to know. So Nathan, I hope your question was answered. I think there's a hands up from Annie Abba. Annie, if you are still on, you can kindly ask your question.
Thank you. Please, my question I've typed, but then I want to speak to it. So how many stakeholders so far have they engaged in terms of the external auditing firms from Bank of Ghana? And how many of them from the international or the big fours to the local firms? How many of them have been engaged so far? And how many of them are aware of these new directives? Apart from the fact that it might be published somewhere, you know. And then secondly, what are some of the key emerging risks that we should anticipate in the gap analysis? Thank you.
Thank you very much, Annie. I don't know if Peter or Mauko wants to take this.
Okay. Yes, thank you. As part of our ongoing engagements, we shared these directives with the ICA Ghana so that they could also share these directives and guidelines with their members. So that's the approach we generally use. We have plans of having further engagements with ICA, which would of course include the Big Four and the other local auditors. So that's basically our plans moving forward. With regards to the emerging risk, I think I did talk about one key one that has to do with the operational risk and resilience. especially with our industry being overly reliant on the IT and information technology. So, of course, there are some risks in that aspect that we need to focus on. I believe most people are aware that last week we launched the revision of the Cyber and Information Security Directive. So that is one key directive we needed to issue because of the emerging risks with regards to information technology. So largely, credit risk remains an issue. And so it's coming in different forms because of the new forms of products that banks are developing. So we had to really look at what the requirements would be in order to ensure that we are able to address all the gaps regarding credit risk. So that's why we intend issuing the credit risk management directive. Thank you.
Thank you very much, Malco. I think Daniel also has a question. Daniel, you can ask your question now.
Yeah, thank you, Erica, and good morning to everybody on the platform. Special good morning to Kwame. Kwame, I haven't seen you for a very long while. I see you and the doc taking a very strategic position on the issue under discussion, and maybe later on I'll come to find out how much it will cost me to participate in the boot camp and the rest that you are talking about.
Okay, that's related.
Yes. So I think basically for banking operation, the major risk that they face is the credit risk. BOG is there to actually, continuously assess and see how through regulatory regime will be able to assist the banks to, achieve stability, transparency, and then good governance. But what we have realized consistently is that we find the banks, are actually avoiding the private sector, which is their main focus, and you find them investing heavily in government securities for obvious reasons. I want to find out from the reps from the BOG here, are these issues or this directive that they have brought to the table adequate to actually engender confidence in the banks to look at the credit, look at granting credit to the private sector as their main market. Thank you.
Thank you, Daniel. Dr. Situ, Mauko, Peter, I don't know if any of you wants to take this.
Yes, is the issue of the banks or the banking industry actually granting facilities to the private sector has always been an issue for years now, largely because they want to be safe, more or less. And where we had treasury bills, government securities with very high interest rates, of course, they would rather place their funds in those areas. But we need to look at things now. Interest rates have drastically gone down, right? So the expectation is that now they would have to, of course, undertake what exactly, or the main reason for banking, which is financial intermediation. So that's our expectation moving forward. The idea of these regulations is to promote the safety and soundness of industries. So once the industry is safe and sound, then that serves as a platform for them to confidently go out there to grant facilities, knowing that they have the needed risk management controls in place. So that is basically what these directives intend to do. So once we have that platform established, we expect that our banks and SDIs would go into more of what they are originally required to do, which is financial intermediation. At the same time, we need to look at it from two angles, not just from the banks, but also from us, consumers, customers. At the same time, customers who were also not too keen on going to banks to take facilities because of the high interest rates. But fortunately, we have those things going down, especially with our monetary policy rates going down. The Ghana reference rates, the GRR, has also been going down. You can always visit the Ghana Association of Banks website to look at the rate, which is the base rate for lending. I think it's currently at 11%. So with that going low, we know that customers would also now be more interested or more keen in actually visiting these banks to request for facilities. So it's in both aspects, and we need to look at it from that angle. But all in all, once we have a more safe and sound industry, more stable industry, then the expectations are that our banks will be able to grant facilities to the real sector. Thank you.
And just to add that if Daniel, if you are very particular, even in the news now, you hear lots of banks advertising and asking clients to come for credit. So it's all a testament to how far monetary policy have come in terms of ensuring that the rates are good enough. And just like Marcus said, with the setting of the GIR at around 11%, it's a good time that bankable projects, companies just appear to go to their bankers and then see what kind of deals they can get. We are in very good times when it comes to credit. So with the right risk management metrics being put in place by the banks, and I am sure almost all of them are online listing, I believe that there's that leverage that will be taken advantage of, and there will be economic expansion within our country. Thank you.
Thank you so much, Peter. I was just about to read Kofi's question, but I see his hands is up. Kofi, you can go ahead. Kofi, if you are speaking, your mic is on mute. Okay, so let me read Kofi's question since it's already in the chat box. Kofi is asking that given the direction of the draft Bank of Ghana directives, how do you see banks evolving their funding structures beyond the traditional balance sheet lending, particularly in the areas like structured trade finance and receivables-backed liquidity solutions? Anyone can take this. Kofi wants to know how is this going to evolve the funding structures beyond the traditional balance sheet lending. Mauko?
Yes, we're already seeing this evolution. I mean, that is the beauty of banking. The industry evolves. So we're already seeing this, where we see a lot of banks moving into trade finance and some receivables-backed solutions. So that is what we see, and that is the more reason why these directives become very important, because once the industry knows our expectations, if you look at our directives, we tend to indicate what the supervisory expectations are. So once that is now clear to them, they now know how best to package these products, right, in order to ensure that at least they've met the minimum requirements. So, for example, now they know that in coming out with such products, they have to consider liquidity. Their liquidity position. They have to consider some stress tests that they need to do, right, in order to determine in a forward-looking approach whether they best have the resources to manage risks that may come along the way. So these things become very critical in order to ensure that they have that foundation, that platform, in order to involve themselves in such products. So for us, moving forward, these directives become even more relevant, even more important for us, that the banks implement these directives, because then we are comfortable that our industry is aligned. And mind you, when they are involved in such products, they are also engaged with other countries, what we call cross-border transactions. And for most of these other countries, they are already aligned with these international best practices. So we cannot be behind. Okay. The foreign investors would also be keen on whether our banks are aligned with such regulations, which are aligned with the best practices. Once that is observed, they become even more interested in investing in our industry with our banks. So the issuance of these directives cannot be overemphasized. Thank you.
Marco, before you go, there's also before we move to the next question, there's another question from Samuel. And Marco, I want you to take this question. So someone wants to know, how do these regulatory directives serve as a buffer for banks and financial institutions against the risks arising from geopolitical tensions, particularly conflicts such as the ongoing Middle East crisis?
Yes, that's an interesting question. So that is one of the reasons why we issued the stress test guidelines. That is key. Okay, because what we are trying to consider right now is a more forward-looking risk management function of our industry. That's what we are trying to look at now. So now that the industry knows that there is the geopolitical tensions out there, what are the implications to us, to the macroeconomy, to the banks, to the industry, to consumers, for that matter? How does it play out? How does it impact on the various value chain? We need to know. And that is the reason why we issued the stress test guideline, because we expect that our banks, specialized deposit-taking institutions, would now conduct such stress tests. They would have scenario analysis being done, consider the underlying assumptions. And this is where the board becomes very key, board and senior management, because we expect that the board should have some appreciation of all these scenario analysis, the models that they are going to use, what is happening out there, so that they can better challenge the stress test results that would be churned out. Okay, so these are reasons why we had to issue the stress test guidelines. Thank you.
Thanks, Malco. I think we'll take one last question. We have Nana Kwabna. Your hands is up. Nana Kwabna, you can ask your question. Okay, since we are not hearing from Nana Kwabna, I see Sadiq Ata. Your hands is up. Sadiq, you can go ahead.
Yes, thank you, Erica. My question is on the impact or the effect this framework will have on corporate governance, okay? Especially in relation to ensuring that there's proper oversight by the various committees in place. I don't know how we are tying in these new directives requirements to corporate governance, especially in relation to the chairing of our various committees. And it's good you mentioned that the cyber is one of the areas we are looking to strengthen. So the question is, are we also looking at enhancing the independence of these committees along with the introduction of these new frameworks?
Okay, thank you very much, Sadiq. Malco, would you like to take this?
Yes, thank you. Thank you so much. Corporate governance is key. like we always say, if the fish is to rot, it usually would begin from where? The head. So similarly, we always ensure that the tone is set from the top, which is the board, and of course, the senior management. What we have in our corporate governance directive, and of course, the corporate governance disclosure directive, remain standing. And these directives are generally supposed to be read together with the corporate governance directive, as well as the risk management directive that we issued back in 2021. So they all move together. That is why when you look at our directives, usually the first bit of the requirements has to do with governance. You'd always see that when you look at our directives, the part two usually starts with governance, the expectations of the board, then we trickle it down to the senior management, then we trickle it down to the risk management function, then we trickle it down to the internal audits. Okay, because we always are focused on the 3 lines of defense. And for us, that is very important to us. So the internal audit being the 3rd line, the risk management and compliance being the 2nd line, and then we have the business line, which is the 1st line of defense. These 3 are key to us, and we try to make sure that in all the directives, they are clearly spelled out. So because of that, they always go together. You can't do one without the other. And the fact that we always have requirements for these areas, especially the risk, especially the internal audit, re-emphasize the importance of the risk board committee, the audit board committee, the chief risk officer, the internal audit officer. It re-emphasizes their importance, their independence, their powers or authority that we expect them to hold. And that is why it's key that we always read these directives in conjunction with the corporate governance directive, the disclosure directive, as well as the risk management directive. So they go hand in hand and they support each other. Thank you.
That's a very good one.
Erica, just to add to the excellent response from Marco. So if you read the corporate governance directive very well, you realize one of the things that we always emphasize is collective suitability on the board. So I think the gentleman just gave an example of the CSID directive that we had issued. So it will be one's expectation that within the board, there will be various skill levels. That would even include IT, because just like Marco said, one of the risks that we are looking at going forward is the AI area. And you'd want people with some IT background. The corporate governance directive is very comprehensive and has that overarching effect of ensuring that the bank looks at everything in totality: risk, audits, HR, IT, whichever area that is necessary for the smooth running of the bank and ensuring safety and soundness is promoted when it comes to the directive. So just like you said, all these 6 that we are issuing go hand in hand with other directives that have been already issued to ensure that at the end of the day, we achieve whatever results that we are looking at the central bank. Thank you.
Very much, Peter. For the rest of the questions, we can keep them coming. We will answer them in collaboration with BOG, and then we'll share it with you all. So you can still type your question in the chat box. We have a few minutes to wrap up. And I want to call on everyone, any one last word: Charlotte, Kwame, Mauko, Peter, and then Dr. Situ will come in. Finally, if you have the last word.
Okay,
before we
thank you very much, Erica, and thanks to my fellow panelists and everyone on the webinar. I think that it has been very interesting discussions, and I'm actually looking forward to these the emerging risk directives and all those that are yet to come. I think the Bank of Ghana has all our interests at heart. Some of the directives may seem to be daunting, but I believe that with the right engagement and consultation, we should be able to, the bank should be able to work on them, carry them out. And of course, the consultants are always available. We are always available to give the support and direction as needed. And I believe that things will turn out better for all of us. Thank you.
Thank you. Thank you, Mama Shao. Peter Kwame, you can also speak. Otherwise,
okay. So I think that I want to say a very big thank you to Deloitte for organizing this. It's been very insightful. We as a department within the central bank stand ready to help. Marco talked about the various engagements that we'll be having. We would make sure it covers a lot more of the stakeholders than even previously envisaged. And we want to indicate that we stand ready to work hand in hand with all stakeholders to ensure that our banking system is very safe and sound and very resilient. Thank you very much.
Thank you, Peter. Kwame, Mauko, any last words from you before Kwame comes in? And then Dr. C2 would finalize. Yes, Mauko, go ahead.
Yeah, just to reiterate what my boss said, we just want to thank the Deloitte for this opportunity. We always look forward to such platforms where we can share our thoughts, especially the spirits behind these directives, because you can be behind your desk, read these directives, but you may not appreciate the spirit behind these directives and guidelines that we issue. So Deloitte providing such a platform to us is of great importance, and we are very grateful. Thank you.
Thank you, Mauko. Thank you. Kwame, you can go ahead.
Yeah, thank you, Erica. And I would like to thank all the participants because we announced this at a very short notice, and the participation of this webinar has been immense. Even as we speak now, there are about 317 people on board, and I would like to say thank you to all for coming over, spending your time to listen to these directives. And I believe that we are going to work together and ensure that we build a resilient banking services sector in the midst of uncertainties. So I want to thank Deloitte. I want to thank the Bank of Ghana too for coming up with these proactive guidelines and directives so that we can have a better banking for all of us, so that Ghana would be where it's supposed to be.
Thank you so much, Kwame, and thank you to all our panelists. Thank you to all the participants. Now let's hear from our host, Dr. Situ.
Yes, ma'am. So thank you very much. I think it's been wonderful, and I want to say a very big thank you to everyone. Bank of Ghana, let's do it. And it has happened. Over 330 participants across the industry. That is lovely. On point. Deloitte, we always have more for you, right? So we are also going to have another webinar, but this time around is going to be on the reporting standard, the financial reporting standard. We are going to have a webinar for the new financial reporting that deals with presentation and disclosures in statements. And that is going to happen on I just want to get the date right. No, can you go back to, yes. So the date for that one, I think somebody is just rotating this up and down. What date do we have there, Erica? Sorry, if you can help me with the date.
Thursday, next week.
It's 9th April. So we are going to have the one specific to the bank. So just show the bank one because that is what is relevant to them. So we are going to have IFRS 18 webinar, and of course, it's free of charge. And this is a new standard that will affect or impact the way the financial statement will be presented. All right. And it's a new standard which is also effective 1st January 2027. It means that for 2027, there is a lot of changes that is coming, guys. A lot of changes that is coming. So we are going to have a webinar on the 9th of April. Please put it in your calendar. It's 9th of April. And we are going to debrief IFRS 18 and how it will impact banks specifically. We have others for other industries, but the bank one is happening on the 9th of April. So don't miss it at all. And the presenters, myself, I'm going to present. Charlotte is going to present. Richard Omari is going to present. So it's going to be very insightful and very engaging and informative. So make sure you are in this webinar also, because it's a very important one. And what can we do to help? After all said and done, we've talked about the regulatory changes and things like that. What can we do to help? Let us help you to conduct a gap assessment. That is very, very important. All the regulatory changes coming up, we can assist. We can help in draft policies. We can help in training your board, training your senior management. Let us help you in that. And then also automation. You know, when these things are coming, you want to automate them so that you can focus on the core of your business. We have had a very interesting case studies when it comes to automation. Let us employ AI for you to automate some of these processes, to automate some of these regulatory changes. So we are available to engage, and I think you really enjoy it. And then, as I said, the second edition of the banking bootcamp is coming up in July. So the date has been confirmed. It is coming up in July. Okay, July. So a few months down the line, the banking bootcamp is coming on in July. Now it's going to be an intensive 3 days. We are going to camp you in a very nice hotel. This was the last year. Last year, this is where it happened. So it was an interesting one. You could see the pictures. You could see some of your colleagues enjoying the banking bootcamp. So don't miss out the banking bootcamp this year. This year is going to be interesting, very engaging, and very exciting. With all these directives that has been issued, we want to deep dive into it. We also want to deep dive into IFRS 18. We want to deep dive into things so that when you are coming out, it will be worth it. So prepare your money, prepare your time. Deloitte is money and your time. And it will be interesting to attend. So Erica, I think I will end here, and we hope to engage the industry more. And I hope that you will respond to all the Deloitte calls. When you see me coming to your office, please welcome me, because I have good news for you. Thank you very much, and God bless you all. See you very soon for the webinar and then the banking bootcamp. Thank you, guys.
Thank you.
Bye.
Thank you, Dr. Situ. Thank you, everyone. Thanks to our participants. We are most grateful for your time. Thank you so much, and see you in the next webinar. Bye.
It's been awesome. It's been impactful. The first ever 2025 banking bootcamp for CFOs. From the very first day, it's been one level of insight into the other, one level of impact to the other.
And the most significant area, particularly IFRS 7. we miss it a lot.
The cornerstone of our audit is understanding your client business. So if you don't take time to understand it, then you start from the wrong perspective.
Someone trusting that you act fair.